The $130 billion bill. Meta just watched its free cash flow collapse by 90% in a single quarter to fund a $130 billion infrastructure bill. Wall Street immediately panicked, sending the stock down nearly 10% after July's earnings report revealed the sheer scale of the capital drain. Yet Nvidia's Jensen Huang is aggressively defending Mark Zuckerberg's spending spree. This is not about technological camaraderie. The chipmaker is actually defending a strategic maneuver that forces the entire industry's profit margin down into the hardware stack. The margin trap. Nvidia's defense of Meta is pure margin protection disguised as industry stewardship. Meta's latest open-weight model, Glimmer, released this August, intentionally gives away the software layer for free. If the intelligent software costs nothing, the entire profit margin of the AI industry is forced violently down the tech stack into the hardware layer. That happens to be the exact layer where Nvidia holds a monopoly. Zuckerberg's strategy commoditizes the developers, ensuring that enterprise dollars flow straight into hardware procurement rather than software licensing. Every billion Meta spends on servers is a billion locked onto Nvidia's balance sheet, effectively acting as an outsourced research subsidy. But pushing that much capital into silicon created a structural breaking point that Nvidia is now using institutional financing to hide. The $500 billion buffer. The core problem is that hardware depreciates fast. To stop Wall Street from punishing hyperscalers for buying compute that becomes obsolete in 36 months, Nvidia just engineered a massive financial buffer. On August 10th, Nvidia launched a $500 billion financing consortium with asset managers like BlackRock and Blackstone. The goal is to rebrand short-lived graphics processors as long-dated, utility-like infrastructure. By doing this, they can domicile the debt on institutional balance sheets instead of tech company earnings reports, shielding hyperscaler operating metrics from further stock hits. And that specific financial sleight of hand exposes how the entire market just quietly transitioned into a massive credit risk story. The collateral shift. The real implication of Meta's cash flow collapse and Nvidia's new banking consortium is that the underlying market has transformed from a computing race into a credit risk story. You do not build a $500 billion third-party financing vehicle if hyperscaler revenues can sustainably fund the hardware transition on their own. By combining Zuckerberg's massive capital drain with Huang's sudden pivot to debt structures, it becomes obvious that the ecosystem is running out of organic runway to buy chips at current margins. Nvidia needs Meta's open-source strategy to succeed because it forces the market to consume more physical compute, while the institutional partnership keeps the purchasing pipelines artificially inflated. The financial risk hasn't disappeared. It has simply been transferred to the bond market. For operators tracking this space, the metric that dictates the next phase isn't inference speed or model parameters. The specific indicator to watch heading into Q4 2026 is data center lease securitization rates. The exact moment institutional lenders demand higher premiums to hold aging hardware debt, the hyperscaler spending cycle snaps. Subscribe for more.